How should retirees report annuity income on their taxes? Imagine receiving a steady stream of income every month and wondering how it affects your tax return. That's a common question for many retirees with annuities. Let's break down how to report that income clearly and accurately. First, it's important to know if your annuity is qualified or non-qualified. Qualified annuities are funded with pre-tax dollars, like from an IRA or employer retirement plan. When you take money out, it is usually taxed fully as ordinary income. Non-qualified annuities are paid with after-tax dollars, so only the earnings part of each payment is taxable. The original amount you invested is not taxed again. When you start receiving payments from an annuity, each payment has two parts. One is a return of your original principal, which is not taxed. The other is the earnings or interest, which is taxable as ordinary income. To figure out how much of each payment is taxable, the IRS uses a method called the exclusion ratio for non-qualified annuities. This ratio is calculated by dividing your initial investment by the total expected return based on your life expectancy or contract terms. The ratio tells you how much of each payment is tax-free and how much is taxable. If you have a qualified annuity, you usually report the entire distribution as income. If you took the simplified method, which is common for those under age 75, you divide your cost basis by the total expected payments to find the tax-free part. For annuities starting after age 75 or with different terms, the general method involves more detailed calculations based on actual payments and the amount invested. When your annuity is annuitized, meaning converted into a stream of payments for life or a set period, each payment includes a part of your original investment and earnings. Over time, the taxable part increases until you recover all your initial investment. Retirees should keep good records of how much they invested and the contract details. Using IRS worksheets from publication 575 can help you determine the taxable portion of each payment. Spreading out withdrawals can also help manage your tax bracket. Remember, some states do not tax annuity income or offer partial exemptions, so check your state rules. If your annuity is in a retirement account like an IRA, you must also follow required minimum distribution rules, starting at age 73 and increasing to age 75 in the year 2033. These distributions are taxed as ordinary income. For inherited annuities, the beneficiary reports the income as ordinary income, and the tax treatment depends on whether the original annuity was qualified or non-qualified. In summary, how you report annuity income depends on the type of annuity and how payments are structured. By understanding these rules and keeping accurate records, retirees can report their income correctly and avoid surprises come tax season.